Hello option traders, this is Sal for SL Trading Group, and I want to make a video today covering gold and the massive drop of today. It was a 5.3% drop in gold, but more importantly for option traders, the increase in volatility and option premium that the 5.3% drop has caused. So right here what you see is the gold chart, and this red bar obviously is the 5.3 as of the close percent drop in gold. And notice all these small bars in gold trading. These are all daily bars. And then this massive red bar. I'm going to show you the volatility, and then once we look at the volatility, you'll look at the different option prices to see how you can trade this depending on your view, bullish, bearish, or sideways. Before we go over the options, I just zoomed out quite a bit here on this futures chart on the gold, and we're looking here at the April gold, and what you'll notice are the major levels to look at. The highs were high 190s, well low 190s, but closer to that 2000 level, and the lows recently have been near the 1520 to 1500 level, and we're going to use those levels in selecting our strikes. Here's a chart of GVZ, the volatility on gold, and what you'll notice is a steady downtrend in volatility. It was as high as 40 to 43% volatility for the year, and it's been in the 20s, this gold. The problem with this is that it's hard to put on new trades if the premium is low, because it just means that it's moving less and less, and the option premium is lower as the gold has been not moving very much or been on a steady uptrend in a volatility crush. What you'll see today was an increase of almost 14% because of that massive 5.3 drop. You see this big green spike in volatility. So depending on what your views are on volatility, if you have any, that might also affect your trading. So you have to combine your views on the volatility, whether it'll increase bearishly or decline eventually, and then apply that to the prices. I have here in front of you a list of different options. Most of these are the 2000 strike with some additional strikes as well, and different months, all call options. I'll show you the put options as well. But what you'll want to do if you're shopping for options, assuming you're going to want to see this market move up a little bit in the gold, so you can short some calls. We're starting with the bearish because it dropped. It looks like the June 2000 call might be worthwhile, and that'll range between $500 and $1,000 for a short call. I also found that the August strikes, if you want to do a vertical spread, might also make sense. For example, you can go as far as the 2300 and 2500 strikes. You can sell the 2300, buy the 2500, and you might collect about $300 to $400 for $2,000 risk. That might be an interesting just to even think about. If we go over to the chart, if you short those calls, gold hasn't been quite up to 2000. Once gold would start to go up, you would look to put on that type of a trade, either a short call or a or half of an iron condor, a vertical spread. If you're bullish on gold and you want to take an opportunity of this drop to short some puts, the 1500 for June might be attractive. 86 days. 1500 is, remember, a support level. And this increase in premium allows you to short that put anywhere from, let's say, $700 to over $1,000, and you're basically getting paid to buy gold at 1500, which it hasn't been there. So that might be an interesting opportunity for you. If you think the market goes sideways, you'd want to put on both of these trades that I just mentioned. You'd sell the put, or even look for a put spread, because you could see an increase, even an increasing trend. And you can sell the call when it goes up and gives you an opportunity to do so. If you have any questions, don't be shy. Give us a call, and we're happy to walk you through any of these concepts.